All right, welcome to the Explainer. You ever see those crypto charts and wonder how some traders just nail those huge moves? Well, I'm going to let you in on a secret. It's not luck and it's not magic. It's a system. Today, we're going to tear down a really powerful framework for trend trading, one that's designed to help you spot those high-probability setups and, maybe most importantly, help you grow a small account.
So, here's how we're going to do this. First, we'll cover the absolute basics. What even makes a trend? Then we'll start stacking tools, building up to what's called a unicorn setup. And we'll wrap up with what is honestly the most important part, the reality of risk.
Okay, let's dive right in. First things first, before you can trade a trend, you've got to know, with certainty, what a trend actually looks like on a chart. And I'm not talking about just chasing the latest green candle or going with a gut feeling. No way. What we need is a clear, rule-based system, a checklist really, to confirm that a real, tradable trend is happening. Because without that, let's be honest, you're just gambling.
So, the source we're looking at lays out a really simple three-step check. Number one is price structure, the classic textbook pattern of higher highs and higher lows for an uptrend. Number two, a break of structure. It sounds technical, but it just means the price smashed through a previous ceiling or floor. And number three, we use a couple of key indicators to back it all up. Okay, so what are these EMAs, these exponential moving averages? The easiest way to think about them is like lanes on a highway. You've got your 20 EMA, that's the fast lane, reacting super quickly to what price is doing right now. The 50 is kind of like the middle lane. And the 200, well, that's the slow lane, showing us the big long-term direction. So when you see the fast lane above the middle and the middle above the slow, that's a beautiful, clean, bullish uptrend. And if they're flipped, you've got a downtrend. Simple as that.
All right, so now we can spot a trend. That's step one. But the million-dollar question is, when do you actually get in? This is where we get to the core strategy, combining our trend confirmation with a really powerful tool for timing our entries.
And that tool is the good old Fibonacci retracement. Look, here's the thing you have to get. Trends don't just go straight up or straight down. They move in waves. They push up, then pull back for a breath, then push up again. The Fibonacci tool is what helps us measure that breath, so we can pinpoint that sweet spot to enter just as the next wave is about to start.
So here's how the whole thing works in practice. First, you use those 3 rules to confirm you're in a solid trend. Then you wait. You let the price pull back. As it's pulling back, you draw your Fibonacci tool and you're watching those key levels, the 50% or the 61.8%. That's your potential entry zone. And check out that stop loss. It's not just some random percentage. It's tucked safely behind a real support level. That's not just trading, that's smart risk management.
And does this work? Well, in one example from the source material, this simple strategy returned a 4.5 to 1 risk to reward. Think about what that actually means. For every $1 you risked, the potential payout was $4.50. You could literally be wrong on 4 trades after that, lose them all, and still be in profit from that one win. That right there is the entire game.
Okay, that core strategy is solid. It really is. But what if we could make it even better? What if we could add another filter to weed out the okay trades and only focus on the A-plus setups? Well, that's exactly what we're going to do next. And we do that by looking for something called a fair value gap, or FVG. Imagine the price moves so fast and so aggressively in one direction that it leaves, well, a gap, an inefficiency. It's like a vacuum in the chart, and the market hates a vacuum. Sooner or later, price tends to get pulled back into that gap, and when it does, that area acts like a magnet for support or resistance.
Now this brings us to a super important idea in trading: confluence. It's just a fancy word for when different separate clues all point to the same thing. So finding a good Fibonacci level, that's one clue. Finding a fair value gap, that's another clue. But when you find a key Fibonacci level sitting right inside a fair value gap, whoa! Now you've got multiple reasons to believe that's a powerful spot on the chart.
And the results? They speak for themselves. An example trade using this exact confluence, it resulted in a 7-to-1 risk-to-reward payout. 7! All we did was add one extra layer of confirmation, and we dramatically increased the potential of the trade. You see, this is how you start to stack the odds in your favor.
So now we're ready. It's time to combine everything we've talked about and hunt for what the source calls a unicorn setup. Yeah, a unicorn. It's rare, for sure, but when you find one, it's about as high probability as it gets. So the first piece of our unicorn is the same foundation we've been using all along. We find our trend, we wait for the pullback, and we identify that key zone with our Fibonacci tool. That's confluence number 1.
Second, just like we did before, we look inside that Fibonacci zone for a fair value gap. So now we've got our key retracement level and a market imbalance all in the same place. That's confluence number 2, and that's already a fantastic setup. But there's one more ingredient to make it a unicorn.
And this is the kicker. Confluence number 3 is when that big, slow 200 EMA, the one that all the big institutional money pays attention to, is also slicing right through that exact same zone. When you get all three, the fib level, the fair value gap, and the 200 EMA all lining up in a tight little area, that's it. That's your unicorn.
Think about it. You've got a key psychological retracement level, a pocket of market imbalance, and a major long-term support line that all the big players are watching. When they all converge on one tiny spot on the chart, I mean, that area is practically screaming for a reaction. It's about as good as it gets.
Okay, but, and this is a huge but, you could have the absolute best system on the planet for finding unicorns and still lose all your money. How? Because finding a great entry is only half the battle. The real key, the thing that separates pros from amateurs, is understanding risk.
And here's the hard truth, the one that so many new traders just don't get. You're gonna lose trades. A lot of them, probably, and that's completely okay. You see, profitability isn't about being right all the time. It's not about your win rate. It's about the math, the simple math of making sure your wins are bigger than your losses.
Just look at this breakdown right here. Imagine you take 10 trades. You lose 7 of them. 7. That's a 30% win rate, which feels terrible, right? But your 3 wins each made you 3 times what you risked. So you made 9 units of risk, or 9R. And your 7 losses only cost you 7 units, or negative 7R. So your net result, you're still up 2R. You were wrong most of the time and you still made money. That is the entire game.
So the real goal isn't to be right all the time. It's impossible anyway. The real goal is to manage your risk so that your handful of big winners easily pay for your more frequent small losers, and then some. Cutting losses small and letting winners run, that's more important than any entry signal I could ever show you.
And there you have it. A really simple, clear framework for trading crypto trends. The system is easy. The rules are clear. It can absolutely give you an edge. But the system isn't the hard part. The hard part is you. Is your discipline strong enough to follow the rules, to cut the losers, and to wait for those A+ setups? The framework is simple. The real question is, are you?